Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. I've run an ongoing series here on the issue of retirement planning that's of most difficult area of me, for the most difficulty, I should say. And that's the area of living too long, which leads to the need for medical care that leads us maybe into a nursing home, or having family members have to take care of us if we want to stay at home. Folks, since I've started this series, and I seem to not be able to finish this, it's because I keep getting into different sections of this area of planning that's so difficult, seemingly, to solve. And the reason is, I don't think it's a solvable area at all. I think it's a necessity of our retirement planning that's often neglected, overlooked, procrastinated, avoided any way possible. And so the issue of medical needs of us getting older is just thrust on us after it's long too late to do any planning. That, I think you'll find, those of you who are listening on the radio to my show every week, and those of you who are getting this video through my emails every week, I think you'll agree, if you think about it, almost everyone that you know, not everyone, but almost everyone that you know, either knows someone or is dealing directly with someone who has a need, either due to failing health, of trying to fragilely stay in the home, and they're grasping more feebly and feebly at, can they still stay at home, to those families that you also know who are dealing with someone who needed to go into a nursing home, or maybe needs to go into a nursing home, and the family member won't let anyone put them there. Folks, this is a difficult situation that pertains to financial planning, because what we run into more often than not is through force, not something that we're desiring. You know, most of our retirement goals are goals to look forward to. But one of the most devastating areas that depletes finances in retirement might not be what happens to taxes. Money getting lost to unnecessary taxes getting paid. Money getting lost to unnecessary expenses, or people spending too much money too fast. It might, through their own choices, it might be this last series or chapter in life forcing assets to be depleted that otherwise the people had done so well at managing their money up to that point, and maybe their money would have lasted forever. So I want you to think, as you listen to me, all the different people that you know that are running into this same situation, and you say, oh my goodness, I feel so bad, I feel so sorry for you. And I'm telling you folks, listen, wake up. This is the new world of us outliving our intended life expectancy of our physical lives, because hospitals and doctors are doing such a fine job at keeping us going longer than we otherwise were intended to be able to survive. But it's causing this increasing difficulty of maybe mental dementia, Alzheimer's, depleting our abilities to care for our own selves, placing us as a burden on our family members. So I have a lot of cases like this, and I know you will too if you stop and think about it. So what I'm doing this show for in this series is how to protect your finances, how to provide for the cost of care, So I'm in the midst of this series, and I'm running through how to shop for, because I'm in the phase of nursing home insurance, planning for nursing homes if you need to go into a nursing home, and also nursing home insurance to plan on how to stay out of a nursing home. I know that's a new one for you folks. I just said nursing home insurance for those of you who are planning on staying out of a nursing home, or how to plan on staying out of a nursing home. Well, hey, we can't control our health as much, but we can control if the reason a person needs to go into a nursing home is because the family members can no longer care for that person at home, or it's no longer safe for that person to be at home, that they might need more advanced care. But folks, finances usually turns out to be the reason why most people are forced into a nursing home. Or maybe I should correct that and say why many are forced into a nursing home. But if we had unlimited financial resources, we might have been able to buy round-the-clock care for them at home, and they would have been able to stay at home. So let's wake up to the reality that due to lack of finances in many cases is what forces people into a nursing home, or lack of financial preparedness that may have allowed the person to stay at home for many more years than they were otherwise able to, because no matter how expensive and no matter how high the cost of nursing homes, it was less expensive and more affordable as compared to the totally unaffordable option of trying to take care of them and buy round-the-clock care to keep them at home. So there leads the question, what if I had unlimited resources? Could they have stayed at home? And if we get sick and need a nursing home type of care, if we had unlimited resources, could we have stayed at home? And the only reason we were unable to stay at home was we didn't have enough money. Not that our medical condition put us into a nursing home, but lack of planning for finances or financial resources enabling us to stay at home caused us to not be able to stay at home. Do you see what I mean? Well, you will in a minute, because I'm going to get into this. Why do we shop for long-term care insurance that seems so expensive? And I'll give you an example that I just ran into this week. Let's say we have someone my age, I'm 59, almost 60 years old, and I look at shopping for long-term care insurance. Let's say we have a husband and wife. Let's say we're shopping for long-term care insurance. Let's say we're shopping for a benefit period of $200 a day, daily benefit, for 6 years benefit, let's say. We want it to pay, if we need to go into a nursing home, for 6 years. That means no matter when I pay for the policy at age 60 and 61 and 62 and 63, I continue to pay for the policy through all those years, for if I develop a stroke tomorrow, it will cover, or I'm 80 years old by now and still have never gone into a nursing home or need the type of care, and then develop that type of medical or mental need. Whenever the period starts, the period of need, then this policy would pay, if I designed it this way, $200 a day benefit up to 6 years. Well, folks, $200 a day equates roughly to $6,000 a month. $6,000 a month, if you look at 6 years, $6,000 a month is $72,000 a year times 6. So it's a little over $420,000 or $430,000, let's say. Total potential benefit. Let's say the premium, I qualify for preferred and my wife qualifies for ultra preferred or something like that. You might see an average premium, if I include in that policy home health care rider benefit, then I'm including whether I need to go into the nursing home or whether I can qualify for care to be received at home. The policy will pay up to $200 a day which is $6,000 a month. And let's take it one step further and say I build in a 90-day waiting or elimination period before benefits begin, somewhat structured as a deductible. And let's finally say I design into the policy a 3% roughly inflation growth factor on my benefit. So that means I'm buying $200 a day or $6,000 a month payable benefit. But because nursing homes go up in cost, and so does home health care, I want that benefit to raise 3% compound. You could buy a 5% compound with many companies also. But let's say in this example I use 3% compound. Now, folks, I'll give you an example of what a package premium might be on someone like that. If we're looking at a 6-year benefit, we might be looking at a $7,000 a year premium, which might break down to about $600 a month for the both combined. And you'd say, see, I told you long-term care insurance is expensive. And I would reply as a financial planner, yes, it is expensive. And then I would evaluate the alternatives. If we don't incur that known expense, what potential consequence could needing into a nursing home 20 years from now or needing care at home be as that expense as an alternative to the known expense that I have today? My known expense today, $7,000 a year, $7,200, let's say, $600 a month. If I look at $72,000 a year, $7,200 a year, over 10 years, that means my premiums, barring any rate increases, potential rate increases, I would have spent, for the two of us, $72,000 estimated over the 10 years worth of premiums. That again, if I never go into a nursing home, is indeed quote unquote wasted. Let's say 20 years. In 20 years, I would have spent $72,000 in 10 years times 2, $144,000 over 20 years period. Now, if I don't go into a nursing home, I'm age 80 and I die, never having gone into a nursing home, I have theoretically wasted $144,000 of money I could have used otherwise in retirement. But think about that. I also didn't devastate or deplete all of our retirement assets or a large portion of our retirement assets potentially due to the need or a prolonged stay in a nursing home because I didn't go in one either. So what I did was I wasted a potential $144,000 over that 20 years period to protect the both of us by taking a piece out of our investable assets every year to protect against, or hopefully protect against, losing all or a larger portion of all the rest. All right, now let's take this benefit. If I have a benefit of 6 years and the potential of $430,000, let's say, is my initial protected benefit for each one of us. Remember, this is a package plan, both spouses. That's actually about $900,000 of protected assets from day one. If I go into a nursing home the next month after I start the plan, it's only a total premium of $600. And then now I have potentially saved our assets from losing at least half of that benefit, which is about over $400,000 for the premium purchase of $600 if it happened in the first month. Well, what if it didn't happen until 20 years? 20 years later, I would have wasted, quote unquote, all that money, $144,000, and you would say, surely I could have done better had I invested it somewhere else. But folks, look at this. The total maximum potential benefit for you and your spouse, if either or both of you have to go into a nursing home 20 or 25 years from now, that total benefit of $900,000, the initial total benefit for the 6 years of nursing home costs, grew by 3% a year. And what that means is $900,000 grows to about $1.5 or $1.6 million on a conservative estimate of a protected amount. What that means is over 20 years, you paid $144,000 to be protected up to 6 years in a nursing home, starting at $6,000 a month, but it's grown to about $10,000 a month benefit for 6 years. Or more than that. And that's per person. So you're looking at a situation of protecting maybe $1.5 to $1.8 million of your retirement assets for a total cost, in this example, of only $144,000, again, barring any rate increases if there are any, and there will be some. But for this example, such a small and affordable, for many of you, cost, a known cost, protecting against such a large and unaffordable, consequential, almost catastrophic loss, if you then at that later point need nursing home care or need care at home. Now, here's the other key that I brought up at the beginning of the show. First off, you're spending small dollars to save inordinately large dollars, potential dollars later, helping maybe your spouse from even being wiped out. But secondly, when you look at this, there is what's called saving yourself from having to go into a nursing home by designing an anti-nursing home concept. Remember, I said this plan that was designed, this theoretical plan on a husband and wife almost near age 60, included home health care rider. And that means, in this case, if one or both of the spouses need cared for at home, this nursing home insurance policy pays and pays and pays and pays up to $6,000 a month per spouse, and by then maybe $10,000 or $12,000 a month based on that 3% growth factor, to keep the spouse at home. If one spouse dies, the other spouse is single, there's no one left to care for that spouse at home other than children's or family member, let's say. And here we have an insurance policy maybe affording 24/7 round-the-clock care, maybe affording partial day care or partial week care, enabling a spouse or an individual to possibly stay at home for far longer and far more years than they would have otherwise been able to stay at home. Do you see what we're doing here, folks? We are preparing in advance, far before a person ever shows signs of needing this type of care, while they're still healthy, and while they can still afford the care, and while they can still afford the premium for that type of care. Folks, if you think about this early enough, you can afford this solution. If you don't think about it early enough, put it off and say, no, it's too expensive, then it will be. Because rather than using pennies to provide dollars for you later, you will be spending dollars to provide those dollars for you later if it happens. Here's the other thing. There's a Pennsylvania partnership plan that says for the amount, an equal amount of whatever you set up for yourselves as long-term care insurance, spending premiums for, to buy the insurance, an equal amount of that same size of your actual assets after you have run out of insurance, exhausted the payments. Remember, we bought it for 6 years in this example. You've exhausted the coverage. It's after 6 years. You still need the care. You're still going strong. That same amount of money in your actual real assets is now exempt from the risk of loss to the nursing home because of the Pennsylvania Partnership Program. So when we look at this situation, we see a case where if you provide early the planning necessary, then you can afford the solution. You can afford to make sure you're not a burden on your spouse or your other family members, and that you have prepared in advance at a very minuscule cost in comparison to the catastrophic cost of self-insuring, as some people will say. But self-insuring, folks, is just ignoring. That's also, nobody self-insures. People just ignore the issue until it's too late and it happens to them and there's nothing else they can do. Now, there are other alternatives. You could do Medicaid planning, give all your assets away, or make sure the government doesn't get them. And I will get into those in this series. But the issue of long-term care insurance is not expensive if you look at it early enough while you're still healthy enough. Those numbers are not expensive as opposed to what it's protecting for you versus what it's costing you will not alter your retirement lifestyle very much. But if you don't buy it, and either of you need it, it will certainly alter your lifestyle in retirement drastically, maybe even wipe out the other one. So that's why I bring this up on this show. You can actually design anti-nursing home insurance. It's the biggest thing lacking, biggest area of inattention in all of retirement planning that I know of. It's the biggest thing missing. It's the biggest thing that nobody talks about. Many financial advisors only want to manage your money. Well, there won't be any money to manage if this type of situation happens. There won't be any legacy to inherit. There won't be any charitable planning left that you could have done, because no matter how well you've laid out the plans, you depleted the assets before you passed away in your last years of life. Won't help you here. So I attack this issue and say, remember I said a chain is only as strong as its weakest link? This is one of the weakest links I find in retirement planning. No one wants to talk about it. And I'm telling you, the ones that do, solve it in advance, or at least mitigate the maximum consequence of having to go into a nursing home or being able to stay at home and the luxury of being able to stay at home. This is a huge issue, folks, that you can prevent yourselves from being wiped out if you plan in advance. Give our office a call. I'll share with you how to do this type of planning. Shoot us an email. Get on our email list, and I'll continue to share many different areas that people have in needs and sometimes nobody wants to address. All right, folks, I appreciate you all tuning in to another edition of All Things Financial. We'll be back again next week, and thanks for listening.
You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through Sage Point Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with Sage Point Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.